Welcome. You're viewing the video version of the Pirls Stock Market Commentary featuring the proprietary bull-bear point and figure market breadth summary chart for March 13th, 2016. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.64 fell from 1.83 last week and continues in less strongly bullish territory. The total count of securities in bullish or bearish patterns fell 7% to 2,984. The count of bearish stocks decreased fractionally, while the count of stocks in bullish patterns decreased 10%. The Pirls PNF market breadth summary chart shows us a market now 2 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly email version of the Pirls Stock Market Commentary free of charge, simply enter your email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 278 points for the 18th advance in 28 weeks. At a positive 105.71 points, it continues below all 6 tops above plus 100 and above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in accumulation mode on higher average daily volume. Momentum. At Thursday 2:25 close, the CCI 20 daily formed a zero-line reject long entry signal within the plus or minus 50 range. At Tuesday 3:08 close, it fell below plus 100, so we exit the trade. The result of this trade simulation was a gain of 51.28 points on the Nasdaq, or 19 cents per share of QQQ. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 4 weeks ago, while the daily CCI 20 began a Woody's downtrend 2 weeks ago. The CCI 20 weekly continues in a Woody's trend down. It rose last week to a negative 25.50 from minus 36.29, continuing within the plus or minus 50 range for a valid zero-line reject short entry signal if it falls next week. Industry rotation the last 2 weeks. All of the top 5 and bottom 5 industries are positive. Bullish, brokers continues in the top 5. CompTech has left the bottom 5. Bearish, networkers, semis, and disk drives have entered the bottom 5. Oil and oil services have entered the top 5. Focus this week from www.davidstockmanscontracorner.com, written by Art Berman at Forbes. Oil prices heading for a fall, possibly hard. The following are some key points. Oil prices should fall, possibly hard, in coming weeks. That is because fundamentals do not support the present price. Prices should fall to around $30 once the empty nature of an OPEC plus Russia production freeze is understood. A return to the grim reality of oversupply and the weakness of the world economy could push prices well into the 20s. Russia and Saudi Arabia have apparently agreed to a production freeze. This is meaningless theater, but it helped lift oil prices 37% from just more than $26 in mid-February to almost $36 per barrel last week. That is a lot of added revenue for Saudi Arabia and Russia, but it will do nothing to balance the oversupplied world oil market, as the chart below makes clear. When storage exceeds about 80% of capacity, oil prices generally fall hard. Current Cushing storage is at 91% of capacity. The Gulf Coast is at 87%, and combined, they are at a whopping 88% of capacity. The negative correlation between the value of the dollar and world oil prices is well established. The oil price increase in February was accompanied by a decrease in the trade-weighted value of the dollar. Now that trend has reversed. Assuming the usual correlation restores itself, that means that oil prices should fall. The OPEC plus Russia production freeze is a cynical joke designed to increase their short-term revenues without doing anything about production levels. An output cut would make a difference, but a freeze on current Saudi and Russian production levels means nothing. It apparently made some investors feel better, but it didn't do anything for me. Iran got this one right by calling it ridiculous. Thank you for tuning in for this week's Santa Pirls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a productive and prosperous week coming up, and wishing you true success.